Hi everyone, and welcome to this video on Chapter 15, Job Order Costing. And the purpose of this video is to do three things. First of all, explain to you what cost accounting systems are in general. Then we'll specifically go into job order costing and what types of companies would use job order costing as their cost accounting system. And then third, we're going to go over journal entries for how costs move through a cost accounting system. So first, we're going to talk about cost accounting systems in general. Now, as we learned in Chapter 14, inventory consists of three types of costs: direct materials, direct labor, and factory overhead. But we didn't really talk specifically about how we track each of those items going into inventory. So that's what a cost accounting system does. It's the specific method a company uses to track the cost of producing goods and services. Now, cost accounting systems are helpful in several ways. On the managerial side, cost accounting systems really are meant to help us capture the cost of making our goods. And this is very important to know when you are determining your selling price, right? You always want to set your price high enough to make sure you cover all of your costs and then also make some money. If you don't know your costs or you're just guessing what you think they cost, you may end up selling your product too low of a price and then not making money. So you want to know for sure what your costs are. Cost accounting also helps with planning the production process. So as you can imagine, producing a product takes a lot of coordination. There's a lot of people involved. You need to make sure that you have the facilities available. You need to make sure that you buy the materials that you need. So a cost accounting system captures everything that goes into the production process so that you know and you can plan to make sure you have enough people in your factory working at that time, that you have enough materials to keep production going. Cost accounting systems also help you track any inefficiencies that there might be. So for example, if you think your cost is supposed to be a certain amount, your cost accounting system will capture the true costs, and if the true costs are more than you think they should be, that may alert you that there's a problem, some inefficiency going on, some waste that you can look at further and then correct so that your business does better. On the financial accounting side, of course, we need cost accounting systems because they provide us with information for our financial statements. It tells us the cost of our inventory on our balance sheet, right? And that's at all levels, the raw materials, the work in process, and the finished goods. So it tracks everything that's gone into each of those stages. It also helps us with our income statement because, again, we need to know our cost of goods sold to know if we made any money. So your cost accounting system will tell you that. Now, there are different types of cost accounting systems, and a company can choose whichever one makes the most sense for their product. So take, an airplane versus a pencil. Two very different products in many different ways, in terms of size, in terms of complexity, in terms of how long it takes to make them. Now, they're similar in that they both have those three elements of cost: direct materials, direct labor, and factory overhead. But the way that we track those costs for each of those products is different because the production process is so different. So there are two main types of cost accounting systems: job order costing that we're going to learn about in this chapter, chapter 15, and process costing that we're going to learn about next chapter, in chapter 16. So the types of companies that would use job order costing systems are companies that make products that are large, high cost, complex, or unique or highly customized. So some examples of this would be any kind of special order printing, whether that be screen printing on a t-shirt, or whether that's printing on a banner or printing books. Even though those items may not necessarily be large or high cost or terribly complex, they are unique. Right? Your accounting book is different than your math book. There's a different number of pages. They're going to have different numbers of pictures in the book and therefore need different colors of ink. So all of those, if there's something very special about each one, you're going to use job order costing. Also, any kind of building construction. they're going to use job order costing because it is so large, high cost, so complex. There's so much that goes into it. They really need to track it, all of those things in a very unique way. Job order costing system is also seen in service industries where each customer gets a different type of service. So, for example, hospitals. Every patient has different needs different medication. So, you're going to charge them based on specifically what that particular patient needed. Same thing with law firms. Every lawsuit is different. So if you're dealing with a different lawsuit, every single one is going to require a different number of hours, a different number of research, different types of filings that need to be done with the court. So we want to track all of those things separately. They're just very, very different. So the way that a job order costing system works is every different customer order is called a job. And we track costs specifically to each job. So hopefully your company has more than one job going on at the same time. So you're going to track direct materials and direct labor based on how much each job uses, because you can track that separately because the jobs are so large and complex and unique. So here you see direct materials going to job 1, job 2, and job 3. It's very specific to each job. Same thing with direct labor. We're going to look at the timesheets, and timesheets are going to tell us who worked on job 1 and how long they worked. Same thing with job 2, same thing with job 3. Now, factory overhead is a little bit different. It is unique to each job. I'm not going to get into the specifics right now. We're going to talk about that later, but that also, again, is allocated to each job. And direct materials and direct labor are added to each job as the work is performed. So as it's going through the process, we're adding those things to it. And this is specifically, important for any production that takes a long time, like an airplane or a building. Your work in process is going to be different at the end of every month because you're adding to it over and over and over again until you get your finished product. So we need to definitely track those items as they're going into the process. And the tool we use to track the cost of a job is called a job cost sheet. So here's an example one, and it will tell you, specifically which job it is. We're making custom dining tables in this job. And you see here, there's direct materials, tells us exactly the materials that went in. There's direct labor, tells us exactly how many hours were spent working on making these tables. And then you also have factory overhead. Again, I'll talk about how we came up with these numbers later. But they're all specific to this job. And then you're going to have multiple job cost sheets for every job. All right, now we're going to move into journal entries, and these are, again, just general journal entries for how we would track costs going through the production process. And this is where your understanding of the ledgers that we started talking about in class last week is really going to help you with those journal entries. So you see here, I've got my ledgers for each separate type of inventory: raw materials, work in process, and finished goods. We've got some others here. We'll talk about those later, but these are the 3 main types of inventory. And I have here my little Post-it note with my debit and credit rules. Those might be helpful for you so that you know which accounts to debit and which accounts to credit. But our first entry we're going to look at is the entry to record materials purchases, right? I know I'm going to make a product. I need to make sure that I have the materials I need, the ingredients to go into that product. So when I buy more materials, I am adding to my raw materials account. So that's why you see here raw materials purchased, and it's on the debit side because inventory is an asset, and the way that we increase an asset is with a debit. So therefore, there's the debit in raw materials, and then here in our journal entry, you see the debit in raw materials as well, adding to the raw materials account. The other side of the entry is however you end up paying for the goods. If you pay in cash right away, you can put cash, right? Because cash is an asset, and if your asset is going down because you're paying the cash, it's going to be a credit. So your journal entry works out with debits equaling credits. In this case, we're going to say that we purchased our materials on account or on credit. We haven't paid for them now. We're going to pay for them later. So that is a liability, a debt that we owe. Our liability is going up So that's a credit. So that's why you see the credit here in accounts payable. Then, once we have our materials, we need to actually use them and put them into the process. So the materials that we used, you see here, they're coming out of raw materials and going into work in process, because work in process is the account that summarizes what comes in and out of the production process. Well, as we use the materials, they're going into production. So that's adding to our work in process account. So again, these are both inventory accounts. But work in process is increasing because we're adding them to the production process, so that's a debit. And raw materials is decreasing because they're no longer raw. They're now in a different phase of inventory. So we're decreasing that type of inventory with a credit. Then, of course, we need to continue to account for all the three types of costs that go into production. That was direct materials. The next one is direct labor. So direct labor adds to your work in process, adds to the value of your inventory. So we're going to debit work in process to add to the inventory. And then the other side of the entry is, again, however you pay for the labor. If you paid in cash right away, you could put cash here as your credit. But in this case, we're putting factory payroll payable. Payable, again, means a liability. I owe it to my employees. So if you haven't paid your employees yet, it's a payable or a liability. Your liability to your employees is going up, so that's a credit. So there we've got the credit right there. And then the third element of cost is overhead. And again, I'm not going to talk too much about the specifics of how we come up with the overhead amount, but I just wanted you to know in general the journal entry and the way that it works is that we have a factory overhead account and we accumulate all of the actual overhead accounts on the debit side. But then as we move them into work in process, we move it using an estimate. Again, I'll talk about that later. But the point is how I want you to know the journal entry to move it, and the movement of it is adding to work in process, adding it to the production process. It's increasing the value of our inventory. So we're going to, again, have work in process being increased with a debit, and then factory overhead is going to have a credit. Okay, then once we've accounted for we've added to the production process, well, hopefully by the end of the month, we've finished some of those items. So those are our cost of goods manufactured. And cost of goods manufacturers, again, they're no longer work in process because we finished them. They're moving on to finished goods. So again, we have our two types of inventory accounts that are being affected. But finished goods is increasing because we finished the product, and work in process is decreasing because they're no longer in process. So that type of inventory is going down. So you see, again, the movement here to record the completed job, the cost of goods manufactured. And then last but not least, hopefully we will sell these products. And the good thing about job order costing is for the most part, you're guaranteed the sale because it is a custom order. Like you ordered this thing, you're going to buy it. I don't have to worry about the goods sitting for too long. They might sit for a little while because it takes time to actually deliver the goods after they're sold. But for the most part, they get sold. So again, this entry really should be just review from 1A showing cost of goods sold is our expense account. Expense is an equity account that decreases equity, so that's why it's a debit. Our finished goods is also going down because we no longer have the inventory. We delivered it. So that's an asset going down, which is a credit. And then you also have to record the other side of the sale, which is the revenue, which is sales. Now, revenue is an equity account that increases equity, so that's why that's a credit. And then hopefully our customer will be paying us. If they pay us in cash, you can put cash right here. Otherwise, if they haven't paid us yet, it's accounts receivable. Also an asset increasing, so that's why that's a debit. So this is going to be your entry for the sale. So that is my summary of job order costing and the journal entries, and we'll talk more about overhead later.